The last time the Fed did this, it wiped out the middle class. So it's important we understand what the Fed is doing, because every time they go down this path, millions of normal people suffer. So today we're going to talk about what the Fed is doing, what it means for us, and how we can protect ourselves. So 2 days ago, the Fed had a meeting and they decided to hold interest rates where they were. Now, holding rates sounds kind of boring. Why would you care? Because it's not about holding rates. That's the headline that everyone's talking about, but something else within the Fed has changed. See, since 2008, the Fed has always bailed out a struggling market. When things get iffy, they cut interest rates. Low interest rates allow cheap money to flood back into the market, flood back into the economy, and boom, everything is fixed, which led to essentially the greatest bull market in history. Obviously, we've had our bear markets in that time. Since 2008, there's been a few bear markets, but they've mostly been shallow, and we've not seen a major recession since. And this is because the Fed has built a dam to hold back the flood, essentially. But the dam is built out of plywood, cardboard, and I don't know, paper straws. We all know how bad paper straws are. So it's built out of that. Every time something bad happens, the Fed chairman, who was previously Jerome Powell, not anymore, he's like, get some paper straws, plug that hole, and they just jam it into the hole. But then a few months ago, Kevin Warsh replaced Jerome Powell as chairman of the Federal Reserve. And at his first meeting as chair in June, he held rates at 3.5%. So he said no cuts, and then he hinted that rate hikes might come. And it was a unanimous vote, by the way. The thing is, he was expected to cut rates. That is what he campaigned on. So his whole campaign was, I'm going to cut rates, I'm going to cut rates. Yeah, Trump, I'm going to cut rates. So it came as a surprise to many when he didn't. So this was basically Warsh saying that we're not using paper straws to plug those holes anymore. But what concerns me isn't the rate hold, it's the change of tone from the Fed. That's the problem, it's the change of tone. They went from hinting at rate cuts to hinting at rate hikes, because Warsh says his goal is to bring inflation back down to 2%, because it's been above 2% for a long time, which, by the way, is a great goal. I hate inflation. You probably hate inflation too. No one wants their grocery bill going up all the time. But the side effect of raising rates is, historically speaking, the middle class getting wiped out. Now, you can protect yourself. That's what we're going to talk about. So what happens during a rate cut cycle? Look, not everyone is the same, but generally speaking, the stock market usually gets cut 20, 30, 40, 50%, sometimes more, sometimes 70, 80%. Your mortgage, your car loan, your credit card go up because interest rates go up, so you have to pay more for those. And maybe you even lose your job if it turns into a brutal recession like 2008. I'm not saying it will this time. I'm just saying that can happen. By the way, if you want to see how I'm positioned for all of this, I've written it down in a free guide on how to retire by 2036, which is 10 years from now. There's a link below. It gets you on my newsletter too. It's all free, so check it out. Anyway, back to it. So how does raising interest rates do so much damage to the economy, to you, to the market? First, you need to understand what an interest rate actually is. An interest rate is the rent you pay to borrow money, or the rent you earn from lending money to someone else. If you're a borrower, high rents suck. If you're a lender, high rates also suck. Why? Because it's way harder to find a willing borrower. No one wants to borrow money when there's high rates. So the Fed sets these rates for the US. Every other rate in the country, from your mortgage to your credit card, is correlated to the main interest rate set by the Fed. So when the Fed cuts interest rates, it becomes cheaper to borrow and easier to lend money. Money then just flows through the system freely. There's money everywhere. Everyone's getting loans. When the Fed hikes interest rates, it becomes more expensive to borrow and harder to lend. Money in the economy gets restricted. It's just no one can borrow, no one can afford to borrow, no one's lending out. So how does it work exactly? Well, if the Fed holds rates at 4%, I know I can buy government bonds, which are essentially me lending the US money and collecting rent for it. And they pay me 4% interest. Easy money. I lend my money to the US government, they pay me 4%. So if you want low risk, steady returns and the government is paying you 4%, you just chuck your money in bonds. You lend it to the government, you don't have to deal with the stress of the stock market. And the higher that interest rate goes, the less attractive stocks become because they are risky. If interest rates were 10%, why would anyone have any incentive to put their money in the S&P 500 when they could just collect 10% risk-free by lending it to the government? That, in a nutshell, is how interest rates impact the stock market. How do they impact you personally? Well, that one's simple. In the 1980s, which is the last time the Fed went on a crazy rate hike spree to fight inflation, it hurt a lot of people. They've obviously raised rates since the 1980s, but that time was absolutely crazy. I'll explain it. So back then, Paul Volcker was the chair of the Fed. Throughout the 70s, inflation had grown to over 10% and people were struggling. I think it peaked at 14.8%. Now, Volcker became Fed chair and he had a plan to fix it. He said, we're going to fix inflation. How did he fix it? He jacked up interest rates to 20% by June of 1981 and the market got crushed. But the effect on the middle class was even worse than the market. Your mortgage went up to 19%. Businesses could not afford to borrow money, so they stopped growing and they had to fire people. The unemployment rate went up to 10%. There were mass protests, death threats against Volcker. These days he's seen as a hero because he did in fact break the back of inflation, that's what people say. He drove it down from 14.8% in March of 1980 to 2.5% by August of 1983. Right now, conditions keep pushing us towards that 1970s style America. The same conditions that bred Paul Volcker. There were a few key differences that I'll talk about later, but let's start with the conditions that bred Paul Volcker and we'll see if Kevin Warsh is actually the next Paul Volcker. So condition one, sticky inflation that just won't go away. So that's checked. We've checked that one off. That's happening right now. Volcker had it in 1979. The Fed has it now. Prices are still climbing faster than they want, and the Iran war isn't really helping the situation. As long as inflation runs hot, the Fed gets to say it has no choice about raising interest rates. And it doesn't take a rocket scientist to know inflation is out of control. My weekly shop was about converting it to USD, about $40 before COVID, then 50, then 70. Now I don't get out of the shop for under $100. The official number says 3%, or it varies, but we all know it's more like 5 or 6%, if not more. Never believe the official numbers, guys. But either way, since COVID, inflation has gone up 64 consecutive months. That is over 5 years of inflation being above 2%. 2% is the Fed's target. Warsh has said that his main goal is to get inflation back down below 2%. Now, of course, inflation is nowhere near the 1970s. I mean, it peaked at 14.8%. We're nowhere close to that. But it's not so much about the numbers, it's about the persistence. That's the problem, is that inflation is sticky. It's staying around. Anyway, let's talk about condition number two, a chairman who is willing to inflict pain. So we'll check that one off too. This is the big one because most chairmen fold. Volcker didn't, and Warsh so far isn't folding, but it's only been a few months. He held rates in June, he doubled down in July, and he took away the promise of rate cuts as his first act on the job. Now the big question is Warsh the second coming of Paul Volcker, or will he fold? I think there's a good chance that he will fold, especially after the midterms, but who knows? What do you think? Let me know. Condition three, no rescue is coming. So we'll check that one off because it seems like no rescue is coming. So for the last 15 years, there was an unwritten deal, and that was that if things get bad enough, the Fed will come and save you. Now, over the last few years, they've been pulling that back a bit, but they keep saying that they're going to come and save you, and that's been enough to prop the markets up. But right now, that deal is off. Warsh has told you in writing twice that he is not riding to the rescue. And Kevin Warsh might not even be able to save the markets if he wants to. See, if he cuts rates right now, he pours petrol on the fire that is inflation. Inflation gets way worse. But what about if he raises rates? Well, the problem is the US government is $40 trillion in debt. If the Fed raises rates for us, it raises rates for the government too. Raises rates on that debt. All of a sudden, the US goes from paying $1 trillion per year in interest to $2, $3, $4 trillion, and boom, bankruptcy for the US. No one wants that. So both roads are ugly, and the Fed, they're kind of cornered right now. So let's add up the results. I've given you three conditions, free for free, 100% score. Every condition that let 1981 happen is on the board for 2026, with the caveat that inflation is not as bad today as it was back then. But on the other side of that inflation not being bad is that the debt problem is much worse. If anything, Volcker's job was way easier than Kevin Warsh's because all he had to do was raise rates, crush the middle class, and arguably save America. He didn't have to worry about the US debt because US debt was really low at the time. Now, I can already hear your comments, but Nick, the economy looks fine, unemployment is low, this is doomer talk, and you're right, it does look fine. But markets and the economy always look fine right up until they're not. And nobody talks about it, but the AI bubble is showing major signs of weakness right now. It pumped a little last night, but almost every AI stock is down 10 to 40% right now. So fine is a bit of a stretch. And the job market is the last thing to usually break. By the time unemployment numbers turn, the damage is already done. This is usually because unemployment is a symptom of a recession, not really a cause of a recession. I mean, it's a bit more complicated than that, but that's a simple explanation of it. Then there's other comments saying, okay, but they'll cut rates the second anything breaks. They always do. Maybe that's true, but Warsh already told us twice that they won't. So if he actually holds the line, then we see something from the Fed we haven't seen for a long time. But either way, I don't want you taking my word for any of this. So there are two bits of evidence right now that, don't rely on just my opinion. First, the Fed's record. So Warsh and his gang have every reason on earth to keep you calm. The central bank can't afford to frighten public. So don't watch the FOMC press conference, because the press conference is the public-facing part of it. Watch the meeting minutes. That is the inside notes from the room when they actually talked about these decisions. So their June minutes show some officials wanted to hike interest rates. An insider's job is to keep the economy stable, and they want to push rates higher in a tight economy. So they've stopped wanting to keep things stable and doubled down on fighting inflation. Second is the housing market. Housing affordability in America is now the worst it's been since the early 1980s. The last two times the Fed held rates this hard for this long, you got the early 1980s and then you got 2007. You already know how the 80s went because we just talked about it, and most of you know how 2007 to 2008 went. For those who need a reminder, by the way, in 2007 the Fed held rates high into an economy that was already slowing. Housing had started to roll over. Then autumn of 2008 arrived and the global economy was set on fire. Global financial crisis, it was horrible if you lived through it. Put today's economic data next to the summer of 2007 and we're standing in almost exactly the same spot. We're not at the fire yet. We're at the bit just before the fire where people in charge are still telling you that everything's under control, it's all fine, don't worry. And look, I'm not telling you that a crash is guaranteed, by the way. Anyone who promises you that they know what happens next is lying. What I'm telling you is that the picture we're seeing now is one we've only seen twice, and both times it's ended with ordinary people getting hurt. Even the market darlings are twitching right now. The AI names everyone swore could only go up have been sliding down for weeks. Many are down 20 to 30%, some even 50%. Yeah, they pumped a little last night, but they're still down very, very bad. So the risk is real. Let me tell you the other side of this argument though, because I don't want to just present one side of the argument. I could be wrong about all of this. Warsh might bail out. He might just be putting on an act, pretending he's the second coming of Paul Volcker. Then he stops short of actually raising rates. That's totally possible. They're talking about raising rates in September. We'll see when September comes around if he's the real deal. Before he was nominated, FOMC members felt like he was just a puppet for Trump, who would just cut rates whenever Trump asked. Maybe this is just Warsh acting independent to get the committee off his back, and then he ends up cutting interest rates anyway. Gun to my head, I would say that Warsh is probably still going to chicken out, but there's zero guarantees of that happening, so we don't know. We just have to wait till September and see. But if he doesn't, the market is in for some bad times. But that's not a bad thing for us if we're prepared. So the people who came through 1981 in one piece didn't magically catch the bottom of the market. They just understood what was happening and how to position themselves. These days, everyone wants to be a hero who's called the exact bottom, but it's virtually impossible to do that. I've not done that once in my 25 years. You know what? That's not true. I've done it a few times, but it was just random luck. It wasn't because I'm special or anything. My buys are almost always a bit early, and my sells are almost always a bit early too. That's just how the market works though. But see, I can admit that because I've been in this game for 25 years. I know how it really works, and I don't have to sit there pretending I'm some kind of genius who can call the bottom of every single move. That's just not how it works. Which brings me to the one question this whole thing comes down to. This is the most important question. What should you do about it? What should you do about it? The Fed is going to do what the Fed is going to do. Maybe they hike again and fuck up the market. Maybe they hold and grind us down slowly. Regardless of what they do, you need to decide what you do with your money. Is your money invested or is it sitting in the bank? The middle class answer would be it's sitting in the bank. They have their life savings in the bank and they watch it lose value to inflation every single day, but they don't really notice it. And look, even if Warsh kills inflation for now, it doesn't really change things. Inflation is still going to eat away at your money over the long term. The only people who come out ahead with their money are people who invest their money. Don't believe me? Take a look at the data. If you put $10,000 into the S&P 500 back in 2006, 20 years ago, you'd have $53,000 today. If you put it in silver, you would have underperformed the S&P, but you would have $45,000. It's still growth. If you put it in gold, you would have $64,000. So that's 10K into 64,000 in 20 years. That's growth. The same 10,000 in NASDAQ though, from 2006 to now, $155,000. Absolutely insane. NASDAQ is crazy sometimes. That same 2K in the bank though, if you just left it in the bank to sit there, yeah, you'd earn a little bit of interest from your bank, but it's measly interest. It would buy 5K worth of stuff today. $10,000 2006, it would buy 10K worth of stuff today because it's lost 50% of its value due to inflation. So even the worst investment out of the lot, silver, which by the way, I hold silver. I'm not saying silver is bad. I'm just saying in that period, it was the worst out of the lot. It would have put you so far ahead of just holding cash. People would just put their cash in the bank, just make their banker rich and fuck the bankers. Now, 20 years might feel like forever ago, so let's do the maths from 2016 to now. That's 10 years. So the S&P 500 returned $33,000 if you put 10K in it 10 years ago. Gold returned $35,000. Silver beat gold this time, $36,000 marginally, but it did beat it. And NASDAQ returned $56,000. You gotta love the NASDAQ sometimes. If you held it as cash, congrats, it'd now be worth about 6K. You could buy 6K worth of stuff. You've lost 40% due to inflation. Inflation has been particularly bad over the last 10 years. So let the Fed do whatever it wants. Just park your money anywhere other than the bank. If you have a long enough time horizon, you just have to invest your money somewhere. And when I say anywhere, I don't mean invest it anywhere super risky. I mean S&P 500, gold, silver. You can just chuck it in something that is simple and it will grow versus rotting away in the bank. My portfolio right now is 30% gold and silver. There's some copper and stuff in that pile too. 30% metals, let's say, most of it is gold and silver, 30% stocks and 40% cash. But I'm deploying that cash right now, so my allocation in stocks is going to go higher in the coming months. I just have that cash set aside to buy stocks at discount prices. And we're seeing a lot of discount prices right now, especially in AI. I'm looking to buy some AI stocks now that prices are going down. Even if you start today right in the middle of all this mess, you might get a rocky few years, especially if the AI bubble pop gets worse. I won't pretend otherwise, but you'll come out of the other side miles ahead of everyone who just sits in cash for the next 10 years. People sat in cash are just making their banker rich. Do not make your banker rich. Do not make your banker rich. In the meantime, get in the comments and let me know what you're planning to do to protect your wealth. I'll read and reply to as many comments as I can. I try to reply to most comments. The Fed has already told us what it's going to do. The only question left is, what do you do? Catch you in the next one.